Welcome to Show Me the Money with Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. Good afternoon, everyone. Welcome to the next episode of Show Me the Money with Michael.derk. We have a very good guest today by a gentleman named Leyton Peterson. Leyton and I have done a lot of business over the years on a very hot topic that I think a lot of you are going to definitely want to tune in for on this episode: insurance. Insurance for commercial real estate has been a very contentious issue over the last few years. And Leyton and our team have worked very closely over the years to make sure our clients are taken care of and to make sure that we are truly executing at the highest level. Leyton is a senior commercial lines insurance specialist at Inszone Insurance Services, joining the company in July of 2023 after the merger with Willow Glen Insurance, where we had met. With over a decade of experience in the insurance industry, Leyton started with his career at Willow Glen in 2010, where he developed expertise in commercial insurance, particularly in rental property, apartment buildings, and large real estate portfolios. Leyton holds his bachelor degree in business administration from Point Loma Nazarene University and is a licensed agent in California. Leyton, welcome to the show. Thank you so much for being here. And thank you again for everything you've done for our clients, me included personally, on assets, and as well as our clients as well. We don't take it lightly. It gets pretty interesting out there right now as far as insurance. It used to almost be an afterthought on deals, where it was, a week before closing, hey, call Leyton, we'll just get the insurance and just put it in there, and no one ever thought twice about it. Now we don't even start a deal until talking to you at least high level about where those numbers are going to be, because it could drastically change the underwriting, the rate of return on the deal, and it could really be a make or break on certain deals. So with that being said, let's just jump right into it. Obviously, the insurance market has changed significantly over the years. What has happened, Leyton? Please just be frank and tell the listeners exactly what has happened here. I know you're in California. I previously was in California. Now I'm in Tennessee. What is going on a larger scale? And maybe if you want to touch maybe on California, where a lot of listeners own a lot of real estate there, and we've done a lot of deals together. What is it? Please go ahead.
Sure. Short story, carriers have lost a lot of money. And so they're looking at, different ways to become profitable again. The reasons they were losing money, I think there's quite a few actually combined to create the scenario that, the situation that we're currently in. One of them being lawsuits have become not only more common, but the settlements have increased very significantly. We're calling this phenomenon social inflation. It seems to have kind of come up at a similar time as like the social justice movement. There seems like there might be a correlation there, but generally speaking, especially in California, very litigious, state. The laws being very favorable to tenants and victims, and these settlements also, showing these being much larger than what previously was happening. So on the general liability side, premiums increasing because the claims are simply much larger than they used to be. We also saw, with the COVID, more of that being kind of supply chain driven, but replacement costs have increased significantly. So just the cost to rebuild, a property when there's a fire has increased, anywhere from 30 to 40%. And so, rates, coverage, they have to reflect those numbers. And so you see these premiums, increase because of that. There's also, just the Department of Insurance has been very slow to approve rate increases. And, the Department of Insurance somewhat recently, I don't remember the particular year, became a position, an elected position. And so when this was done, you have someone in as the insurance commissioner that maybe is not as familiar with some of the marketplace, and they want to be helping their constituents, or at least what they think is helping. And so they did not approve rate increases that the companies were requesting. And so the companies are saying, okay, we can't get the rate that's necessary to be profitable in California. So in State Farm's, situation, they just left. They said,
Right.
well, we're not going to continue writing policies that we know are going to be unprofitable. So we're leaving. Now, I mean, I expect State Farm to come back at some point. I mean, California's, the economic opportunity here, with how many people live here, they will be back at some point. It's kind of a question of when. What do their new underwriting guidelines look like? So Department of Insurance also having, I believe, a hand in what has happened. And then, previous years, we were in what we would consider a soft market. There was a lot of carriers being very aggressive and trying to obtain market share. In my opinion, a lot of these carriers didn't know what they were doing. We saw a lot of these companies try to become more profitable by using fewer underwriters, and instead they have these systems that allow us to go in, type in the information, we get a quote, and we can bind immediately. No one ever looks at the property or anything.
Right.
And because of that, there was all these risks going into these carriers that were oftentimes below average and should not have been placed with these preferred carriers, the Travelers, Mercury, the big names that people are probably familiar with. And so they got all this, kind of poor business. It's dramatically affected their bottom line. And so they also just pull out altogether. So, what I'm seeing right now, the carriers that are still writing business in California, they're the ones that they were always doing was underwriting. They have someone always looking at each submission, reviewing the building, looking at the area that surrounds it, and still applying that human touch, and not forgetting how valuable that is.
Right.
And then I'd say the last thing, there's been the natural disasters, wildfires, in California and throughout, even more parts of the United States than just California anymore. And then you see the other, storm-driven catastrophes, the hurricanes, outage,
Right.
big power outage, storm surges, and generally speaking, insurance is one big pool. And when you have those catastrophes hitting, it affects these reinsurance markets, because those reinsurance carriers, which you won't see on your policy, but they are reinsuring your insurance company for the
Right.
big losses. And, they have lost a ton of money. And so they are now telling our carriers, the ones you see on your policy, they're telling them what to do. And they're increasing their rates substantially because they've lost so much money. And
Right.
so, properties in these high hazard zones are getting
So
hit.
high hazard would be near brush or landslides or anywhere near
Yeah,
water that could have, any kind of tsunami or flooding or anything like that,
right.
or
Right.
tornado zones or anything. I mean, it's
Sure.
anywhere like that.
Yeah,
Those are,
even the hail, Colorado, there's a lot of those Midwestern states that have that exposure. California, we have those areas, that have the high wildfire hazard areas. You go to the East Coast or the southern coast, and you got the hurricane
yeah,
exposure.
North Carolina. I know.
Oh,
I just spoke to my friend who lived right there in that part of North Carolina that got hit, and Asheville, and
mhm,
house completely wiped out. And because he didn't have, was it flood, wind, or fire, flood or wind, I guess you need that specific insurance, you
mhm.
will not recuperate your costs. So that's something too that I hope the listeners really take effect here. When you have a piece of real estate, if something happens, and these insurance companies are not looking to pay you just because, it has to specifically be in that policy. So obviously, I think fire is pretty much a given. But if you don't have wind or the hail insurance or something else that could rip out apart your building and stop you from operating, you could be left holding the bag to replace these assets and replace your cash flow too, which would be very, very expensive. And quite frankly, most people may not be able to do it. And that's the scary part of it. It just amazes me that states like California can go ahead and tie the hands of these companies saying, hey, listen, I had to pay for Hawaii. I had to pay for North Carolina. I had to pay for Florida, right? All those outlays. So here's the cost where we have to make it up. And another thing too, that I hope the listeners are seeing this and listening, insurance companies don't lose money. So they just will make it up somewhere else. And the state of California coming in and telling them that, no, they're not going to make it up. It's amazing how they just said, well, thank you. Have a great day. And they're just leaving in Grove. So it's got to be very difficult for you, Leyton, to be able to just constantly manage the market, constantly see who's in, who's out, because it feels to me, overlooking the last couple of years, more of these insurance companies are trying to leave than enter the business and really don't want to capture new business. Maybe I'm wrong, but that's what it feels like. And I think a lot of clients feel that way as well. When their old bill was, say, an apartment building of $300 or $400 per unit per year for insurance, which, whatever, we were able to underwrite that. Now it's $600 to $800 for insurance on this type of, same type of deal with no losses. It changes the underwriting drastically, and it's just very expensive for someone to pay. So maybe if you can touch on that a little bit.
Sure. So, there's in the current marketplace, the buildings that are getting the competitive rates, they need to not only, meet some of the underwriting criteria as respects like building systems, like, one was the electrical updated, the roof, the plumbing, the heating. Do you have a clean claim history? Now there's more data that these carriers are applying, right? So they're looking at even like high crime areas. So even if a building, by itself is, good, if it's in an area that is not considered good, you don't get these competitive carriers quoting anymore.
Right.
If the building next door has graffiti on it, the carriers don't want to quote. There's a vacant lot next door. Sorry, and they've
Right.
just become so conservative. These carriers are looking like, look, if we're going to be in the marketplace, and they're getting absolutely inundated with submissions because there are very few carriers that are, essentially writing. They are going to pick the top 15 to 20% of submissions they get in. Because they have the and they're going to write a lot of business, but it's because they have the opportunity to do that because there's no competition. So
yeah, they can name their price, right?
Pretty much.
Like
Yeah.
you and I had maybe this is a good segue. You and I have a client that we don't need to name names, but they had a property, very high profile property in a mountainous area that was near effectively like one of your danger zones, right? With the brush
Mm-hmm.
and whatnot. And you literally pulled a rabbit out of a hat, and that client is elated. We were very on edge. And this is what people don't understand either. This doesn't just affect your insurance of the property. It's going to be affecting the financing you have on the property too, where we come in and all of a sudden the lenders are calling us and saying, hey, you know what? We've gotten a recent insurance, policy for this building and underwriting. It was $100,000 a year. Now it's $250,000. Wait a second. Ding, ding, ding. We have a debt coverage issue. We have a covenant in our loan documents. We're going to need the client to come in and pay down, $2 or $3 million of the loan amount here. And that's not a phone call I think most people want. So you came in on that deal, Leyton, and you were an absolute rock star. And that client is forever indebted to you. And it was awesome to see you be able to do that. So maybe if you can touch on that a little bit as a real live instance that just happened, about a month or so ago, I think the listeners would appreciate how you're able to handle that and maybe the resources that you have, maybe that some other insurance brokers may not have.
Sure. I think especially in this marketplace, it's really important to come to the carriers with a very thorough submission and pointing out all of the positives, every positive that a building might have. So this particular property, it had sprinklers. It has been incredibly well maintained. It presents very well. And there is also some consideration. These companies sometimes they want to look at their reports. What does the report say? What does this number say? And if it crosses this threshold, we're out. We decline. But there oftentimes is someone over there on the other side that if you can present a compelling, argument, they'll listen. And so as a broker, it's my responsibility to, present these properties as favorably as possible. And yeah, this initially didn't really meet the company's guidelines, but, made a couple concessions on, obviously the pricing was more expensive than desired, but it was far better than what we had previously obtained. I think it's a persistence as a broker to, ensure that no stone is left unturned.
Right.
And,
And
you
the
know,
numbers on that too, Leighton, the numbers that I don't know if you remember, but the numbers where we were to what they were being quoted by the fair plan and where we ended up. Do you remember those three numbers? Just so again, I want people to understand
sure.
the
Yeah.
the
Yeah.
the magnification of these numbers and how out of control it can be. I mean,
Sure.
significantly.
Yeah. Yeah. The expiring premium was 50,000. The fair plan, which would not have complied with the lender's insurance
That's the
requirements.
other thing too. Yeah, you're exactly right.
And,
Yes.
and, and so that was a problem. Even if we could get coverage, and this is something I hope we talk about a little bit more, is even if we can get coverage, does it comply with what the lenders want? And, in this scenario, fair plan does not comply, with this specific lender. And honestly, a lot of lenders don't like fair plan. Um, and so even to do that premium alone from fair plan was going to be, I think it was 140,000. Um, the other scenario was going through the private markets, the Lloyd's of London package. That was being quoted at upwards of $400,000.
Right. Because the fair plan wasn't even an option because the loan would have been called. That's when
Right.
I got called into the situation when they were saying, okay, the insurance doesn't meet the qualifications and the requirements of the lender. So if we put this plan in place, which is 3 times the amount they're paying right now, it still is not going to be it. So there's going to be the amount of outstanding loan was, I don't know, 30 something million dollars that was going to be called at that point in time at a low interest rate. And that was going to be an absolute disaster. And so their option was going to be a $400,000. So now their insurance can go up 8 times on a beautiful property with no claims to solution. And then you finally came in with a final solution. And what was that number? What did that end up to be?
That ended coming in at about 180.
180.
So, yeah,
But at least
still,
it met the guidelines, which was still that's almost 4 times. That's what, 3.5 times the number of what they were paying previously, just a year ago. And now
yeah.
it just changes like that overnight. And so that's the thing here that people just don't realize of what's the scope that is happening on these deals already. There's so much pressure on these properties across the board. And now to put that kind of heavy weight on the expense load, the NOIs are just getting crushed. And so along with interest rates, you got the insurance. Now we're going to see increase of inventory. We call it the 3 I's, right? Insurance, interest rates, inventory. These are the 3 things right now single-handedly that are changing the landscape of real estate across the globe. And unless something gives, it's going to be interesting to see what happens here. So moving on, Leyton, is there anything in regards to insurance that people are overlooking or that should be more proactive up front? So if someone's going to look at an office building today or a retail center or an apartment building, what things should they be looking at right up front? Obviously, getting a quote from you and making sure they know what they're looking at from a financial aspect, but what is it that they should else be looking at and be very proactive?
I think the first thing is, how does it look? The first thing an insurance underwriter is going to do is pull up the building on Google Street View, and they're going to look and how does it present? Is
Those
it
could be 2 years old though on that Google Street View, right?
sure, sure? And so if I'm a buyer, or and I see that that's outdated, um, can I get photos that show that this is more, better maintained than it's presenting just on Google Street View? But this is the first thing all underwriters are going to do. They're going to type it in Google Earth, Google Street View, whatever, and they're going to look and see how does it look. And now they will obviously listen if you provide photos that are current. But your
Hopefully, it
broker
looks
needs,
better than the Google Street View.
yeah, yeah, hopefully it looks better, not the alternative.
Right.
Um, so just number one is, how does it look? Because that alone can result in declinations. They don't even need to ask any more questions. If they don't like the way it looks, um, they they won't even deal with it. And again, because of what how few carriers are in the market right now, they're going to take the ones that present well. So number one is that. And so the things they're looking at: how does the paint look? Is the landscaping maintained? Driveway have cracks in it? The pride of ownership is what they're trying to discern. Does this, either the seller or the current owner, do they care about their property? Have they been taking care of it? Because that's indicative of probably whether they're going to have claims or not. Now, there's great properties that are well maintained and they have claims, but by and large, we do see the properties that are not as well maintained have more claims. So first and foremost, looking at that, looking at what the Street View says or looks like, and then if you have updated photos that present more favorably, make sure you send those along to your broker so that they're aware of that, so they present that to the underwriters.
Okay. Perfect. And then as far as technology goes, how is that going to be impacting in a positive or negative way? Does that kind of go back to that Google Street? Is that a negative, or is there any positive things that clients can do to be proactive with technology?
Sure. We've seen. I, I think the one thing that is good, that is going to come from some of this, and this may be good for some, not all, is the amount of data that these carriers are now able to obtain, allows them to give the preferred rates and the quotes to the properties that are well maintained and do have a good risk profile. There was a time where the premiums for a property in San Bernardino are the same as one for a property in Palo Alto. And uh, for the most part, they probably should not be that way. There should be a distinction in premiums and coverage because of the likelihood of claims happening between the
Right.
two. And so the properties that are in good condition, in more desirable areas, they're going to benefit because that's what the carriers want. Now, on the flip side, if your property's in a higher crime area, it's going to have issues, and it's especially going to have issues. And this is something I've been seeing. I'm sure you're starting to hear the chatter. The lenders, the type of coverages that they're asking for is harder to obtain in these less desirable areas,
Okay.
especially like a Fannie Mae, a Freddie Mac. They get involved and they don't want specific exclusions on the general liability side that all of the carriers want to apply in these high crime areas, because those can be very large claims. So we have this big disconnect right now between what lenders want, what carriers are willing to offer. And there's been quite a few situations recently we've dealt with that. And oftentimes there can be a solution. It is just, you got to pay a lot more. And then there's times where it doesn't matter. There is no carrier willing to offer what these lenders want.
So you're working on specific instances, as our team is as well, where insurance is not an option. So when insurance is not an option, financing is not an option.
Mhm.
So that means your property is a cash buyer, and that means your price is going to be according to cash.
Mhm.
So that's a very big deal. Are you coming? Is it happening more prevalent, Leighton, or are you just seeing it's kind of stagnated? Do you see it getting better, worse? Like what? I mean, I'm just really concerned about this because it's been so drastic, and people are just realizing this when their policies are renewing. Obviously, calling you, calling us, saying like, "Whoa, wait a second, what is this?" And lenders now, when they get wind on it from their servicing aspect, and they're starting to see the policies on a property that may have been a 120 or 130 debt coverage, now is a 105 or a break even. It's a big deal, and it's going to affect the ability for the client to refinance as well, the requirements we're talking about, and then also the debt coverage as well. Most clients we're talking to today that have been purchased and mostly purchased or taken all their cash out over the last 3 years or so. Most people, if they're financing today, are going to be doing a cash in refinance. Very, very little clients who ever talk to are going to be on even a break even basis. Interest rates have doubled. The insurance, obviously, variables, utilities. I mean, every part of the expense load has gone up. And unfortunately, revenue has not offset those increases, even in, a slight degree. So it's, it's a battle. But are you seeing it? I guess just getting back to that question, are you seeing it get worse or are you seeing it get better? Or, where does it stand right now currently?
I'd say it's still getting a little bit worse. I don't know so much as on the pricing side, is that being affected? More so the coverage side, what carriers are willing to offer, that is being reduced. And, there's just not enough competition in the market to encourage these carriers to offer more. And especially in California, carriers come to me and they say, "Look, we're having claims on older buildings," and I mean, most of the California housing stock, the apartments were built in the 50s, 60s, 70s. So those buildings aren't getting any newer.
Right.
And so
They're
there's,
70 or 80 years old already. You know what I mean? Even 80s construction. I remember I was starting in the business 25 years ago. 1980s was like brand new. Everyone was like trying to get an
Mhm,
80s building. Now you're in
mhm.
the 80s and now it's like 45 years old and 35 to 40 years old and you're like, it's not systems are meant to last 20, 25, 30 years. Everything needs to be replaced now. These Zinco panels and everything in these apartment buildings and all these other variables that they're looking at, the insurance companies seems like they're trying to find any little iota to just say, well, we're out of here. We're out of here. And
Mhm.
obviously that obviously makes your job much more difficult to constantly keep changing carriers and talking to clients about the increased costs associated with each one of these deals.
Yeah, I mean, exactly. The companies are telling me, look, so many of these buildings, the systems that are, installed there have outlived their useful life. And so we want to see it either, replaced or we're not going to offer quotes. At least the competitive, carriers are doing that. Um, and there's just really not much to do about it. You can't really avoid that. These are very old buildings, and unfortunately doing that kind of stuff, it's extremely costly, obviously, and
Right.
and that's not to go get back to that, 300, 400 unit. That's to go now still qualify for, 600 to 700 a unit. That's not to go get back to that, great pricing we had. It's
Right.
just to maintain your insurance, it's,
Sure.
yeah, no,
And
completely
owners have
not.
to be realistic because all these expenses we're seeing on every property are just going up. Obviously, if it's a triple net lease, these expenses are being passed on to the tenant. But,
Mhm.
I mean, there comes a break point where the tenant can only afford so much, right?
Mhm.
And if you're rubbing back on utilities and everything, there's only a point where they can only make so much there. You're not ability to bill, as far as I know, for apartments. You can't bill the client or the tenant, I guess, living in your apartment building for insurance. But maybe that's something that a very smart owner can start to do and say, well, my insurance just went up by $10,000, so your rent now needs to go up on a pro rata share basis. But with all the government interventions, I don't see that happening. So, I mean, there's only one way that this goes: is the value of the building has to go down accordingly because the buyers have to absorb this. And I remember the old adage starting in the business years ago, the sellers would be like, oh, the loan, the insurance, you know what, that's the buyer's problem. I'm like, well,
Mhm.
no, it's kind of a you problem too. It's everybody's in
Mhm.
this together. And
Yeah.
so the buyers have the rates of return have remained the same on the assets they're looking to buy, but the sellers are trying to give them something with less return, and they don't understand that that's obviously going to be affecting their value. But it's a very interesting time what we're seeing in the market right now. The shift is very serious, and it's happening at a very vicious pace that we're seeing. But most people who are not in the business every day and not transacting, they're not realizing the impact that's having on these NOIs accretively and obviously on the value of the real estate. Due to all the variables we talked about. Leighton, one part of the show that I love doing, I want to hear something either personally or business wise where you have fallen down and tell us about what happened and more importantly, how you got back up and persevered that much stronger.
Sure. I think back to when I was kind of first starting out, and I learned from my dad. My dad was in the business for
He
20
was.
years. By the time I joined, and he did a lot like the apartments and everything. So I kind of just picked up where he left off. Took the torch, tried to make it a little brighter, burn a little bigger, and
Nice.
ran with it. But really, really, when I first started, I remember we had this one particular client that would call in. You send out the renewal, and he would call in, and he's going to take you through every line of coverage. Ask you about it. He's probably already heard the definition, 100 times, but he's going to ask you about it anyway. The kind of the engineering type, very detailed, hey, you want to understand your coverage, totally understand. But I was very, very new in the industry, and still trying to, get my bearings. And I get a call routed to me. It's supposed to go to my dad, and he sends that guy to me. And I know who it is. And I know what's about to happen. And so I take the call and, just struggled through that. I have never said I don't know so many times in my life. Uh, and I'm kind of in pain. My dad sits about 6 feet behind me. And so he's listening to every conversation I have. And so it's like especially nerve wracking. So eventually, I get through it. I've got a punch list of questions I got to get back to this guy on. And, I turn around to my dad and he's like, there you go. That's what you need to do. Like, you need to just deal with it being kind of miserable at times, like
Mhm.
that's okay. uh, and I got more and more confident being on the phone, despite hating that, and understanding what I was doing. And eventually I got very comfortable, and now I like it. I like when someone calls me. I prefer that over the emails.
Right.
um, it was tough learning how important it was to be on the phone and know what you don't know and be okay with that. Be
Right.
okay with not not having the answer, but being willing to go find it. And
Right.
that guy still stayed around. He's still in the one of our clients, and um,
Good for you.
thankful for that kind of situation. It's just one of many of those probably conversations, but that
Right.
one was
Yeah, newer
especially.
people starting out in the business or any business that is, insurance, real estate, whatever it may be, if you try and fumble your way through and try and BS a client, right, and tell them, especially a client who knows the answers and may just be asking you to test you and to try and make up answers, that's the kiss of death. The best
Mhm,
thing to say is, you know what, I don't know, but you know what, I'm going to check and I'm going to go get the answers and I'm going to get back to you. You know what? They will respect you for that. I would
mhm,
respect someone for that who's trying to sell something or trying to add a service or consulting in some fashion, but never try and fumble your way through where if you don't know something. I mean, that's the key thing, and you learn that on early on in your career. So um, that's great. And I hope the listeners have learned some valuable points from you today. And it was an absolute pleasure having you on. Is there any goals right now that you have for next year as this year kind of comes as a wrap for 2024? What what do you want to do, Leighton, as far as maybe growing the business or clients or personally? Is there anything out there that you're looking to do?
I think continuing to try to educate people, put them in a position so that they can kind of take control of their insurance destiny to an extent, and also just to inform them of like what the carriers are doing. What, like, I want you guys to be able to put on the insurance lenses and look at a property similar to how these companies are doing it. So just continuing to kind of reach out, inform people of what's happening, keeping them current. On the business side, of course, trying to grow, continue to help wherever we can. We're aggressively always making sure we have appointments, with new carriers, anyone who enters the marketplace. Fortunately, we do, a good amount of business. So we do have that ability to pretty easily get appointments with carriers. And I think, again, just making sure people feel confident that,
Yes.
the deal they're getting is good, and for a multitude of reasons, right? Whether it's just pricing, coverage,
Right.
and just trying to give as much guidance as we can, and help everyone. And I think the business comes so long as you take care of those things. So nothing in addition to that, I'd say.
That's great. Well, thank you so much. Again, I hope the listeners really enjoyed the show, and it means a lot, especially with how contentious and how difficult everything is in insurance. We're going to continue to keep working with you. I know we have several mutual clients together over many years of working together. Leyton, I can't thank you enough for taking the time out of your day. Obviously, I know you got probably a backload of calls with people who are not going to be as happy some days calling you. So I really appreciate you taking the time. It was truly an honor. We love working with you, and continue to execute and continue kicking ass. So I wish you well, wish you a great holiday season and a happy new year, and we'll be in touch.
All right. Thanks, Michael. Appreciate it.